right. Good afternoon, everyone, and welcome to the first session in our summer education series. My name is Amy Miller, and I'm the director here at America Saves. And we are so glad you're all joining us today for this important conversation on student loans and repayment options. Now, here at America Saves, our mission is to empower and encourage everyone to build financial confidence and long term savings habits. And while saving money is a big part of financial wellness, understanding debt, especially student loan debt, is just as important. Student loans continue to impact millions of Americans, and the landscape is constantly changing. Between new repayment programs, forgiveness updates, policy changes, and deadlines, leaves many of us feeling kind of unsure of what step we should be taking next. And so whether you're, navigating repayment yourself, helping your child or family member, or just simply trying to stay informed, today's topic, really affects so many of us in a very real way. And so that's why we're especially excited to bring this topic to you today and have our special guest with us. But before I introduce her and turn it over, I do want to say that we will be taking questions at the end. So throughout the presentation, if a question comes up, please feel free to put it in the Q&A box, and we'll be monitoring throughout the discussion, and then we will leave time at the end to answer those questions. So now it is my pleasure to introduce our special guest today, Emma Crawford. Emma is a certified financial planner and a certified student loan professional who specializes in helping borrowers navigate repayment and forgiveness strategies with clarity and confidence. She's the owner of October Loan Strategies, which is a student loan planning firm, and also serves as teaching faculty at the University of Wisconsin-Madison. Emma brings, a wealth of expertise in this area, and we are so incredibly grateful she's taken the time to walk us through these recent changes and what borrowers should know moving forward. So with that, Emma, thank you so much for being here. Welcome, and I'm going to turn it over to you.
Perfect. Thank you so much, Amy, for that wonderful introduction. And thank you to America Saves for putting on such a wonderful and timely event. Like you so beautifully put, Amy, it impacts so many of us, myself included. I actually have student loan debt, and I'm pursuing public service loan forgiveness since I work at a qualifying employer. I grew up lower income, and I really felt alone when I first graduated and had to figure this out for myself. So a huge kudos and thank you to America Saves for putting on such an important and timely event and for having me here today. I really appreciate it. So for the agenda, it's going to go by fast. We have an hour, and I want to leave plenty of time at the end for questions. Like Amy said, if you have questions throughout today's presentation when I'm talking, feel free to stick it in the chat, and we'll touch base on those at the end. I have a quick disclaimer. Then we're going to move into important and timely updates as they relate to the One Big Beautiful Bill Act, or OBBBA, which was signed into law summer of 2025. Then we're going to talk about forgiveness options and repayment plans, and then end with action steps to consider and some resources at the end. So quick disclaimer, as we all know, so much changes with student loan repayment and forgiveness options. So they can and do change. The rules, options, etc. Everything changes every few years, it seems. And so the information that I'm sharing today is what I know to be true today, which is May 20th of 2026. And it's important to note too that the views that I express today during this presentation are my own only and not necessarily those of America Saves or UW-Madison. And lastly, I am a financial planner, but not necessarily your financial planner. So what that means is I really want you to use this presentation for educational purposes only. It should not be used for tax, legal, or financial advice. So let's start with the One Big Beautiful Bill Act and its impacts, especially as it relates to student loans, because there is this kind of upcoming deadline of July 1st that might apply to some of you listening here today or listening to the recording. So July 1st, 2026. You may have seen a lot of news articles about this, a lot of buzz on the internet about this July 1st deadline. So it is a very important date in the student loan repayment world. For those of you who have student loans and don't plan on taking out more on or after July 1st of 2026, there still might be some things that apply to you as well. But what's really important to note is if any of you are on today's call or listening to the recording, if you take out federal student loans out on or after this July 1st of 2026, the repayment plans and therefore the forgiveness options and opportunities will vary greatly. So we're going to have like these borrowers that were pre-July 1st of 2026 and then July 1st, 2026 and after. So it's really going to be this kind of like dividing line between groups of borrowers as a result of this one big, beautiful bill act. So what do I mean? What do I mean by repayment plans and forgiveness opportunities? I'm going to touch base on those and describe them in more detail on the next slide here for us. So if anyone on this call or any of your loved ones, friends, etc., if they have loans or if you have loans dispersed on or after July 1st of 2026, it's very important to understand that the only repayment plans available to you will be the repayment assistance plan, which is a new type of income-driven repayment plan, or the tiered standard plan. So I know that there are a lot of acronyms and jargon in the student loan planning world and finance in general, which makes it even more confusing. So just as a quick refresher, when I talk about income-driven repayment plans, I'm using that as like an umbrella term. An income-driven repayment means that there are specific plans where the monthly payments are based on your income and family size and your state of residence. So this repayment assistance plan, it's brand new. It's not even offered yet. They're expecting it to be offered to borrowers or for borrowers to be eligible to apply for it sometime this summer. They think July 1st, but we'll see. So that will be the only income-driven repayment plan. And then we also have this tiered standard plan, which instead of the monthly payments being based on income, the monthly payments are going to be based on the loan balance and the interest rates. So this tiered standard plan, it would range from 10 to 25 years based on the loan balance at the time a borrower enters that plan. So very important. So if you have loans dispersed on or after July 1st, these will be the only plans available to you. The biggest bummer, I think, really relates to Parent Plus loans. So Parent Plus loan borrowers, if you are listening today, please know that if you take out another Parent Plus loan on or after July 1st of 2026, you will not be eligible for any income-driven repayment plan. This is, like I said, very detrimental to Parent Plus loan borrowers. So this essentially blocks them from ever receiving forgiveness through public service loan forgiveness and income-driven repayment forgiveness. And we'll talk about those in a little bit here. Because as part of those forgiveness programs, you need to be on an income-driven repayment plan. And if you're not eligible, you're just not eligible for forgiveness then, right? Because you're not eligible to complete the requirements. And with this too, the really unfortunate thing is that a spoiled apple ruins the bunch. What I mean by this is if a borrower has some loans that were dispersed before July 1st, 2026, and then they maybe even have one loan that was dispersed on or after July 1st of 2026, that one loan spoils the whole bunch. So that means these new rules apply as if all of the loans were then dispersed on or after July 1st of 2026. So this spoiled apple ruins the bunch. It's very important to know that. Especially if you plan on going back to school or if you're a Parent Plus loan borrower who plans on taking out additional Parent Plus loans in the future, it is very important to know that this would apply to you. So when I'm working with parents, for example, who are taking out Parent Plus loans, we might have one parent stop borrowing so that way they can kind of preserve their income-driven repayment forgiveness eligibility or PSLF eligibility, and then switch to the other parents, especially if the other parent is working in the private industry and isn't targeting any PSLF forgiveness in the future. So very, very, very important to know this. And we'll talk more about this July 1st, especially if you are not taking out any more loans in the future as it relates to these forgiveness options and repayment plans as well. So let's dig a little bit more into the specific repayment plans and the forgiveness options. So I am a top-down processor, so I always like to start with this bigger picture and then work my way down. So in my work with clients, and usually in these webinars as well, I'm always thinking about these forgiveness options that you might be eligible for, you listeners who are tuning in today or listening to this recording. I'm always thinking about public service loan forgiveness for folks who are working at a college like me, another academic institution, a nonprofit, a hospital, local, state, federal government, the armed services. If that applies to you, or maybe it did in the past, and you have worked or at least or are working an average of 30 hours per week, you might be a good candidate for public service loan forgiveness. If you're not working at a sort of nonprofit or government or academic institution, you might want to look into income-driven repayment forgiveness. So whereas PSLF, or public service loan forgiveness, is really tied to your employer, the income-driven repayment forgiveness has nothing to do with your employer. What you need to do instead is get on an income-driven repayment plan, and we're going to talk through each of these options, like pay, income-based, or pay as you earn, income-based repayment, ICR, income contingent repayment, the new repayment assistance plan. Those are all types of these income-driven repayment plans. So if you stay on that plan for a certain number of years, the balance remaining is forgiven at the end. Important to note, though, the biggest plus side of PSLF is any amount forgiven is tax-free, whereas anything forgiven underneath an income-driven repayment plan is considered taxable income again, starting in 2026 this year. I apologize. It was paused for a little bit, but that taxation is now set to resume this year for loans forgiven in 2026 and beyond, unless the tax law changes. So for both of these forgiveness options, why I like to bring them up is just to kind of help raise awareness, because many people don't even know that income-driven repayment forgiveness exists. In fact, there's a huge study done a few months ago, so really recently, that showed that around half of all federal student loan borrowers didn't even know that income-driven repayment plans were an option. So I really try to raise awareness whenever possible. The other thing is we're going to take some time talking about these different income-driven repayment plans. And the important thing to know is those plans are requirements for both of these forgiveness options. And I love income-driven repayment plans because the monthly payments are based on your income. So theoretically, they should be affordable. And it's possible to get a $0 payment depending on your income too. So we'll talk more about that in a little bit here. So let's kind of start digging into these specific plans. And one more thing too, I also want to raise awareness of this because I see this all the time with clients. There was something called a one-time account adjustment underneath the Biden and Harris administration. And what they did was they kind of retroactively gave credit toward forgiveness, which could count toward income-driven repayment forgiveness and or public service loan forgiveness for months that would not ordinarily count. So what I mean by that is if maybe someone paid late, or they had a certain number of months of deferment or forbearance or non-payment, or maybe they paid less than the amount due, or were on an incorrect repayment plan, like maybe they were on the graduated repayment plan or extended, that would not ordinarily count toward forgiveness, but it does now because of this. And so this has already applied to borrowers' accounts automatically and was completed in early 2025. And so I see this all the time. When I'm meeting with clients, they are amazed that they likely have more credit toward forgiveness than they ever thought possible. I actually just had 2 clients within the past month got a combined over $300,000 forgiven because of this one-time account adjustment, and they both got their loans forgiven through public service loan forgiveness. So if anyone out there is listening, if this happens to one person, it's totally worth it. If you have prior employment experience that could qualify toward PSLF, even if you're not working there now, go to studentaid.gov, look up the PSLF help tool, and document all of your employment history, because those months you might be able to get credit for those, at least for PSLF, going all the way back as October of 2007. And for those of you who might not be eligible for PSLF and might be eyeing the income-driven repayment forgiveness after anywhere from 20 to 25 or now even 30 years, I have a tool linked at the end of these slides that will be shared out in a follow-up email by the end of this week. So you can use the tool to help estimate how much credit you might have toward income-driven repayment forgiveness as well. All right, so let's dig into these plans. So important to note that if a borrower doesn't choose a plan, or maybe for those of you who are on the save forbearance and not making payments, and maybe you don't choose a plan and are forced off of it eventually, the standard plan is what I call the status quo. It's really the default plan. And it ranges now for borrowers with loans before that July 1st kind of deadline, it ranges from 10 to 30 years, depending on when the loans were dispersed and whether they are consolidated. Like I said before, the monthly payments, instead of them being based on income, the monthly payments are based on the loan balance and the interest rates. So basically, depending on the term length, it will amortize that loan, kind of similar to like a mortgage, honestly, over that term length. And so so the payments stay the same throughout that repayment period, and then it guarantees that the loans will be paid off by the end of that repayment term. And so this, of course, it's not a good option if you are gearing up for forgiveness or keeping an eye toward forgiveness through public service loan forgiveness or income-driven repayment forgiveness. But it's important to note too, like this is a common plan, but only because it's really the default or the status quo. So if a borrower graduates after school and they don't elect a different repayment plan, they'll be put on the standard plan. And same with folks, at least we think so far, for those who are on the save forbearance and not making payments and don't elect a new repayment plan by the time that they're really kicked off, we are thinking that they will likely be put on the standard plan. So this is really the status quo. So monthly payments are based on the loan balance and interest rate. And now we have my favorite, like I said, which are these income-driven repayment plans. And I'm going to probably start saying IDR for short. So when I say IDR, I mean income-driven repayment. So that is a beautiful umbrella term for the specific plans underneath it. So we have the pay plan, pay as you earn, income-based repayment or IBR, ICR is income contingent repayment, and then RAP is the repayment assistance plan. So all of these plans, pay, IBR, ICR, and RAP, are a type of IDR or income-driven repayment plan. And it can be a little bit confusing because there are a lot of changes happening, right? So this is where I see the most confusion. It's completely understandable. Like this system is not built for us to navigate it very efficiently or quickly or easily as well too, especially with all of these changes kind of coming down. Important to know though, income-driven repayment plans is that not everyone qualifies for every plan, but everyone qualifies for at least one. So eligibility might be based on when the loans, or I should say eligibility is based on when the loans were taken out. For the pay plan, you need something called a partial financial hardship. So your loan balance needs to be, usually bigger than your income, for example. But for each of these plans, the monthly payment will be based on your income and family size. But each of these plans kind of calculates that monthly payment a little differently. And so the next slide, I put together a quick chart that kind of goes through each of these plans. Really important to note. So I have this RAP, old IBR, new IBR, pay, and ICR. A few things before I dig into this is, and this is really applicable to the Parent Plus loan borrowers on this call. I cannot emphasize this enough. If you have Parent Plus loans and you're not planning on taking out any more, and you have not yet consolidated them, meaning you have these different Parent Plus loans, or maybe you just have one, but you have not applied to consolidate it through the consolidation application on studentaid.gov, you need to. Because the wonky thing and unfortunate thing about Parent Plus loans is they need to be consolidated before they are actually eligible for an IDR plan. So for any of these plans. If someone, this like literally keeps me up at night, but if a Parent Plus loan borrower misses this July 1st deadline, meaning they don't consolidate beforehand, they will never be eligible for an income-driven repayment plan. So if you have Parent Plus loans, or if a loved one has Parent Plus loans, please spread the word. You need to consolidate as soon as possible, ideally yesterday, because it takes a while for that consolidation application to be processed and for that loan to be dispersed. And that new loan needs to be dispersed before July 1st of 2026 to preserve eligibility for income-driven repayment plans. Very important. So now that I got off my little soapbox for that, I can talk more about it during the question section as well. But I really like this slide because it goes through each of these different repayment plans and it shows how that monthly payment is calculated. RAP, like I said, the repayment assistance plan, it's not even available yet, but we think it will be sometime this summer. July 1st is kind of what they're targeting. The monthly payment is based on 1 to 10% of your adjusted gross income from a recent tax return. The unique thing about the repayment assistance plan is that it has an interest subsidy, meaning that if you are at least making the minimum monthly payment, which is $10, So you can't get a $0 payment on RAP, but you could get a $10 payment. The interest will not grow like it does underneath these other plans. Another thing I wanted to touch on with this too is you'll notice that income-based repayment technically has two versions, like the old version or the new version, and it just comes down to when you took out the student loans for the first time. So you'll notice across all of these plans, there are different eligibility criteria, different repayment lengths. And so that repayment length is really important for those of you who might be pursuing income-driven repayment forgiveness. So that kind of tells us, okay, I have to be on the old IBR plan for 25 years or new IBR for 20 until I'm eligible for forgiveness. The nice thing is that if you are on pay, let's say, and then switch to IBR, the time spent on pay counts toward forgiveness on the IBR plan. And on that note too, with pay, lots of confusion about this plan right now. This is another really important thing I wanted to mention as it relates to the July 1st, 2026 deadline. I don't quite know how to say this eloquently, but it used to be that the pay plan, you had to be on it by July 1st, 2027, and then they'd eventually phase it out on July 1st of 2028. Now, because of some confusing language that was recently released, student loan planning nerds, our community is worried that you have to actually be on it by July 1st of 2026. So if you are on the save forbearance and you are, earmarking forgiveness eventually, and you're eager to kind of get off of the save forbearance and onto a different plan, if you are not eligible for new IBR because maybe you took out your loans before that July 1st, 2014 deadline, and you want to get a cheaper payment, pay is a great option, but you need to apply soon. And so I'm working with a few clients on this right now too. Like, we are worried that you actually have to be on the plan by this July 1st of 2026 deadline, which was recently kind of found out or figured out. So some confusion about that. We're hoping to know more soon, but in case we don't, it's really important to apply for pay as soon as possible. ICR isn't a super common plan, so I'm not going to talk too much about that, but it's important to know that that's also going to be phased out as of July 1st of 2028. So if we think about, which plan is safest or which plan has the most longevity to it, I really like the income-based repayment plan. It's codified by Congress. It's considered safe. The administration did try to get rid of it 2 times in the past year and were unsuccessful. So to me, that kind of shows that it's a sturdy plan. It's predictable. It's safe. So I really do like income-based repayment. But for those of us who might not be eligible for the new IBR plan, because maybe you're like me and you took out your loans before the 2014 deadline to be eligible for new IBR, pay is a good option because the monthly payment is calculated the same as the new IBR plan. So it usually results in a low monthly payment. So I really like the new IBR version. I also like pay for the meantime, but old IBR is good too. It just results in a higher monthly payment because it uses 15% of your discretionary income. And so with the next slide, I believe I talked through an example of how to actually calculate that discretionary income. So this is really what comes into play for the income-based repayment, pay as you earn, and income contingent repayment plans. So I know studentaid.gov has a loan simulator. I'll be totally honest, I hate that thing so much. I do not find it to be super helpful. I do have a calculator linked at the end of these slides, and I really like the VIN calculator. So it was actually built for veterinarians, but I use it with my clients because it's so easy to use and it's free. You just have to make an account first. So it's the VIN student loan estimator, I believe it's called. So I like it better than the student loan simulator on studentaid.gov. But with IBR, pay, and ICR, they use a proportion or a percentage of your discretionary income. So what I mean by that is they will usually take a recent tax return from the past 2 years, so whichever one was most recently filed. And if they use a tax return, they're specifically looking at your adjusted gross income. So if you're curious what that is, it would be line 11 of the Form 1040 from your tax return. You can also use a pay stub as well. So they would then use your federally taxable earnings on a recent pay stub. And then what they do is they subtract a certain percentage of the federal poverty guideline for your state and family size. And I have those linked as well too. They change every single year. So they usually increase, right, as inflation increases. So they take your annual income and then they subtract a certain percentage of that federal poverty guideline depending on the type of plan it is. And then that is what equals your discretionary income. So when we see discretionary income, that's how they calculate that. It's not really based on spending, although sometimes I wish it was, because especially if you live in a high cost of living area, that would make a bigger difference. And then they multiply that by a certain percentage based on the plan, and then they divide it by 12 to get your monthly payment. So that is how they calculate these monthly payments. And so sometimes I actually like to do this in Excel, or you can even do it with a pen and paper and a calculator. If I like physical handouts too, or doing things by hand sometimes, just to fact check the student loan servicer's math and even the student loan simulator on studentaid.gov too, because sometimes it is incorrect. So I think it's really helpful if we can know more or learn for ourselves how exactly these monthly payments are calculated. And then the next slide has the repayment assistance plan calculation as well. So this is a little bit different in that instead of it being a proportion of your discretionary income, they're actually going to use a percentage of your adjusted gross income. So anecdotally, we will typically most likely see higher payments on this repayment assistance plan for borrowers because of how the monthly payments are calculated. And if, let's say, someone makes no income, and they enroll on the repayment assistance plan, they still have to pay a minimum dollar amount of $10 a month toward that plan. So whereas with IBR, pay, and ICR, it is actually possible to get a $0 payment, you can't get a $0 payment on RAP. But like I said, with the repayment assistance plan, it has something called an interest subsidy, where that unpaid accrued interest will not continue to grow each month as long as you're making your minimum monthly payment. So the repayment assistance plan could be a good option for folks who maybe aren't sure about public service loan forgiveness or income-driven repayment forgiveness in the future, because whereas under the other plans, that unpaid accrued interest that might be accruing each month, it continues to grow over time, whereas it does not do that with the repayment assistance plan. So it is a really nice thing about RAP is that interest subsidy and what makes it pretty unique. But like I said, we will anecdotally see higher monthly payments under the RAP plan for most borrowers. Not all, but most. And that VIN calculator that I mentioned, if you just Google VIN, student loan repayment estimator, I'm sure it will come up very quickly. You'll be prompted to make an account first, but that will also show you these monthly payment calculations across each of these plans too, which is very helpful. So I really want to note this, that $0 payments are possible. So if someone is making $0, let's say they're in between jobs or they were recently let go, it is possible for borrowers to get a $0 monthly payment while on IBR, pay, and ICR, depending on their income and family size. And so I want to share this because a lot of borrowers don't know that these low payments are possible. And the nice thing is that $0 payments while enrolled on an income-driven repayment plan count toward income-driven repayment forgiveness and public service loan forgiveness. So that's something I focus a lot on with my clients, is how do we reduce these monthly payments as much as possible in order to maximize forgiveness at the end. And so a lot of people don't know that, especially if they've fallen on tough times, which happens to all of us. Maybe they were recently let go, or maybe they're having a health crisis or something like that. Unfortunately, a lot of borrowers end up going into default because they aren't able to make their regularly scheduled monthly payment on the standard plan, let's say, and their servicer doesn't do a good job of encouraging them to apply for an income-driven repayment plan where the monthly payment would have been $0. So I've seen this play out time and time again, unfortunately. And so I just try to share this whenever I can too, to the masses, is that it's possible to get a really low monthly payment on these plans. Like I said, you can either indicate that you have no taxable income, you could use a tax return, you can use a pay stub. It's just important to know our options, right? Especially if money is really tight, it's possible to get low monthly payments on these income-driven repayment plans and have those monthly payments, or $0 payments, count toward forgiveness. So this is something I help my clients with all the time, and it's really rewarding to be able to do so. All right, so with this SAVE plan, hot topic, right? Because this has been a mess. It's been a dumpster fire for probably 3 years now, because it's essentially been blocked since then, which is really unfortunate. So as it stands right now, borrowers who were put on the save plan are now kind of, I call it the save forbearance, meaning no payments are due. You're kind of stuck in between a rock and a hard place. Many people are kind of paralyzed really by indecision, right? I was actually just talking to my vet about this yesterday when I was with my dog at the vet. A lot of borrowers are just stuck wondering what to do because this has been going on for so long, and payments aren't technically due now, but they will be very soon. So I really want to emphasize is that even though no payments are due, they will be soon, and interest is accruing. And what I mean by payments being due soon is that you will eventually be kicked off onto probably the standard plan. So I think that a lot of notices will start going out to borrowers this summer, probably in July or maybe August and September, and borrowers will be given a certain amount of time to either elect or to apply for a different plan or elect a different plan, or they'll just be automatically put into the standard plan. So I get this question a lot from my clients too. Is SAVE coming back? No, not for the foreseeable future. Do not hold on to any hope for SAVE. It's not coming back anytime soon. And I'm encouraging borrowers to switch plans now because time spent on the SAVE plan does not count toward forgiveness, such as income-driven repayment forgiveness and public service loan forgiveness. If you have been stuck, due to no fault at your own, by the way, this is not anyone's fault. If you've been stuck on the SAVE forbearance and you are pursuing public service loan forgiveness, you can use something called the PSLF buyback to buy back time spent on the SAVE plan, but that's a whole other dumpster fire and mess. Like the wait time for processing is 1 to 2 years for right now. So if you are on the SAVE plan, I should say on the SAVE plan or stuck in this forbearance, I really recommend switching. I think that it's going to be like a mad dash eventually, and there are going to literally be like tens of thousands of borrowers stuck in the queue. I mean, really over 1 million borrowers stuck in the queue when they are forced to apply for different plans. So if we can get you ahead of that queue, I would love to do that. So I do recommend applying for a new plan ASAP. Of course, I couldn't tell you which plan because it really comes down to what your eligibility is and what your income is. But I would really highly encourage you to look into switching as soon as possible to kind of get ahead of the curve a little bit here. So with advice, you're like, okay, Emma, this is great. This is super helpful, but what do I do now? That's a great question. And let's start there. What should you do? And remember, this is education only, not really advice. So action steps to consider. If you have Parent Plus loans and you have not yet consolidated them and you're not planning on taking out Parent Plus loans in the future, and you want to be eligible for forgiveness, meaning through income-driven repayment forgiveness and or public service loan forgiveness, you need to consolidate like yesterday. And so by yesterday, I mean, then you need to consolidate right now because we can't go back in time, right? So if you want to maintain eligibility for forgiveness, you need to apply to consolidate the Parent Plus loans on studentaid.gov. Consolidation takes either one Parent Plus loan or these separate Parent Plus loans and combines them into a new federal direct consolidation loan. And that new consolidation loan, you'll be eligible for the ICR plan. So you'll have to make one payment on the ICR plan, and then you can switch to the IBR plan. So if this rings a bell for you, you need to consolidate as soon as possible. Because if that consolidation loan disperses on or after July 1st, it will not be eligible for income-driven repayment plans, and then forgiveness is out the window unless the laws change down the road, which we can't bank on, right? I wish I had a crystal ball. It would make my job so much easier, and I'm sure it would make all of us feel better, right? Very important to know that for Parent Plus loans. If you are stuck in the SAVE forbearance and you've kind of been stuck wondering what to do and aren't sure, I really would encourage you to look into your different income-driven repayment plan options and apply to switch. So studentaid.gov has an income-driven repayment plan application that you fill out online. Thankfully, it's pretty straightforward, and you can indicate which plan you want to switch on. If you are thinking that you eventually want to get on the pay plan, if you're not already on it, I would also really encourage you to apply for the pay plan as soon as possible, especially if it does become the case where borrowers needed to get on it by July 1st of 2026. For those of you with any employment history that could qualify for PSLF, I really encourage you, if you haven't already, to use the PSLF help tool on studentaid.gov to document all of your employment history going as far back as October of 2007, because that's really the first time that someone could have started accruing credit toward PSLF. And actually, that's why my business is called October Loans. October is the first month for PSLF, which is kind of a cool fact. And I want to know too, I see this play out with my clients, is it's important to note that it's an average of 30 hours a week. So I actually had a client who was working, 40, above 40 really. So she was a teacher, 45 to 50 hours a week, although you can only put 40 hours on the application. She was working 40 hours for the bulk of her time, but then dropped to 20. And so she didn't think that the years that she spent working there as 20 hours a week would count toward PSLF. But because of this average, she qualified for PSLF and got her loans forgiven. So I really want to emphasize that it's an average of 30 hours per week during the time period you're certifying. If you are a teacher and let's say you are your contract kind of lasts a year, but you don't technically work the summer months, or maybe you took FMLA or parental leave or things like that, that time still counts toward PSLF. So you can still get credit for those summer months. You can still get credit for FMLA or parental leave. That time counts toward PSLF. And as a result of that one-time account adjustment underneath the Biden and Harris administration, many people are shocked to see how much credit they have. All they have to do is fill out the PSLF help tool to document their past employment history. And then eventually, once everything's processed, their PSLF qualifying payment count will show up on their studentaid.gov dashboard, which is really nice. And then, of course, tons of helpful resources. So I know the America Saves will send out a follow-up email to all of you who are here today and to everyone who registered with these links in the email as well. So I really tried to only highlight like my favorite resources or ones that I use pretty often, including application and tools, student loan assistance. So for those of you who are interested in getting some free student loan advice, I really like TISLA. Betsy is amazing. It's free. She's super knowledgeable, so smart. I really recommend reaching out to TISLA as well. I offer paid services, and so TISLA is a great option for free student loan advising support. I don't think they do appointments and things like that, but they're usually happy to help answer questions through email. And then, of course, too, if you're like, oh my gosh, Emma, you said so much that I wasn't familiar with, or I'm curious to learn more about it. One, I don't blame you because all of this is very confusing. And so I do have additional readings linked here as well to kind of help just with education, right? Because I just threw a lot of information at you over, 37 minutes. So I really tried to also provide some additional readings to help with some of this as well to help make it more clear.
All right, great information, Emma, so far. And we do have some questions in the chat. So if you're ready, we will get started with that. Okay.
Let's
So
do it.
the first one is a PSLF question. And it says PSLF options, 120 payments do not need to be consecutive. Can there be a lump sum payment that covers X number of payments?
Theoretically, yes. So I think they allow people to apply a lump sum payment up to 12 months in advance, but I will be super blunt. Like I'm a really blunt person, so I'm going to give it to you very bluntly here. I would really not recommend doing that. And the reason being, if you haven't already, the reason being is that I've heard nothing but nightmare scenarios where someone makes a big lump sum payment and they don't get the PSLF credit that they should have gotten, meaning like the servicers and federal student aid just don't apply those payments correctly. And so I never advise my clients to make a lump sum payment. I'm like, keep it in a high yield savings account, make those payments every single month that you're working for a PSLF eligible employer. Don't try to mess with the lump sum if you haven't already. Unfortunately, I wish it were easier, but I would not, but it's not. So I don't recommend doing it.
All right, great. Okay, perfect. Good answer. All right, the next question. Is it realistic that a person in Save Forbearance could complete an IBR or pay disbursement by June 30th, given processing time if they are starting the process today? Did you follow that? You want me to read it again?
I understand the question. I guess for a follow-up, do they mean that Well, so that's a good. I think I understand the question. Like, if you apply for an if you submit an income-driven repayment plan application today, would it be processed in time? So, if you use a tax return and consent to IRS access during the application, yes, those are actually being processed within a week. So, if you go to studentaid.gov, fill out the income-driven repayment plan application, consent to IRS access, meaning it allows the Department of Education to look at your most recently filed tax return from the past 2 years, that will probably be processed in about a week or so. If you do like a paper application or you upload a copy of a tax return or a copy of a pay stub, that's taking 4 to 6 months. So that is probably not realistic. So it's a very kind of night and day difference, unfortunately, for those, just because of the backlog right now.
Gotcha. Well, and if that was your question and it didn't completely answer it for you, please feel free to put another question in the chat and we'll try to get to it. But I'm going to keep going, right? So
Perfect.
the next one is, does the RAP interest subsidy only apply to direct subsidized government loans?
Ooh, that's a good question. So I have to fact check that really quick because so studentaid.gov has a really, I can like see it in my brain. They have a really helpful chart, and I'll try to find it too if we have the time to. Studentaid.gov has a really helpful income driven repayment plan page that goes through each of these different income driven repayment plans and the eligibility criteria. And so it's so new, I can't say yes for certain, I can't say yes or no for certain, but there is on studentaid.gov, it might be studentaid.gov/IDR. And then if you click on learn more about the different plans here, it should take you to a page that has the chart for the types of loans that are eligible and more information about it. So I wish I could answer that confidently, but I cannot. And so I encourage you to look at studentaid.gov and the income driven repayment page to learn more about it. That's a great question. I'm sorry that I couldn't answer that directly.
No problem. So here's one. To be clear, if you are on Save Forbearance, can you switch to IBR after July 1 because IBR is not ending?
Yes, that's a good question. So, as long as you're not planning on taking out loans in the future, right? So, you're done borrowing, you're on the Save Forbearance, you will absolutely still have access to income based repayment after July 1 of 2026. So, IBR is not, there's no plans to end it. So, that will continue to be available as long as you don't take out loans on or after that July 1st, 2026 deadline.
All right, great. Have another save question. So we'll keep going if you're good. We've got some good questions in here.
Yes, yeah, this is great. Yes, absolutely.
Okay. And we've got some time. So, all right, another one. I was in the save plan, converted end of last year to IBR. With the new IBR, will switching cause the remaining payments due on the PLSF to increase? And also, does the pay plan work for PSLF?
I hope I'm understanding the question. So switching from SAVE to IBR would have caused an increase because of how, SAVE was such a beautiful plan because of how the payments, I should say, would have been calculated. It really resulted in lower monthly payments than we see on the other plans. So switching from SAVE to IBR would cause the payments to increase, most likely, but it's because of how the payments are calculated under IBR than how they were under SAVE. And then pay, to answer the second part. I hope I answered that first part okay, but if I didn't, please feel free to put a follow-up in the chat. IBR, pay, ICR, and RAP all count toward PSLF. Yes.
Perfect. All right. We're going to keep going. Yep. Another one. They say, I went to student aid website. The default repayment less than consolidated monthly payment plan because of interest rates. So they're saying the default repayment plan is less than consolidated loan monthly plan because of interest rates. Should I stay on consolidated, but want to be considered for, basically they're asking, should they stay on the consolidated to be considered for public service?
Don't know if I understand the question. I apologize.
Yeah, and I'm sorry, once I started reading it, it became a little more complicated. So clarify your question and we can come back to it.
I
But
will
if you,
say, yeah, if I could take a stab at it, I will say like once someone consolidates their loan, so let's say someone graduates and doesn't consolidate their loans, the standard plan length will be 10 years. But if they consolidate it, that can then stretch the term from like 10 to 25 years. So maybe that's kind of the heart of the question. Or I guess maybe I wanted to throw that out to the audience just as a heads up that consolidation does stretch out the standard plan term length based on the balance for loans dispersed before that July 1st date. But yeah, feel free to put a follow-up question in the chat so I can kind of get to the heart of it.
okay. Let's see. We're gonna keep going though. We've got a few more. So this one says, I was put on save forbearance, but unknowingly, and now those payments that were made are not counting towards PSLF. Can I use the buyback to get those to count? They say they should be at 120 in September, meaning 120 payments, right? But it's telling me that I'm missing 15 months due to this. So, what steps should they take?
Yes, great question. I know, and it's super unfortunate because people were moved from repay to save automatically, and then things got paused and it stopped counting, which is really frustrating. So, like I said, a lot of this is no fault to the borrower. No, it's not due to the borrower's fault or anything you did wrong. Which maybe I don't know if that makes it better or worse sometimes, right? Like it's really frustrating. But yes, you can absolutely use the PSLF buyback option to kind of buy back these months that you spent on the save forbearance. As of now, you can only apply for PSLF buyback when you, how do I put this? You can only apply for PSLF buyback at the very end, meaning that the approval of buyback needs to result in the loan forgiveness. So the months spent on the save forbearance need to get you to at least 120 qualifying payments. So it is something that maybe it sounds like you could apply for that in September because September should have been your 120th month. So there's a helpful page on studentaid.gov. If you go to studentaid.gov and search for PSLF buyback, there's a whole page that kind of shares more information. But the basic premise is that in September, then you should submit another help tool to document your employment. So that way you have 120 months of documented employment, and then you can apply for buyback at that time. The unfortunate thing, though, is the processing of these applications is taking 1 to 2 years. So I had a client apply in July who still hasn't heard back, for example. So you might be forced to continue making payments. You could ask your loan servicer if you could be put into a deferment or forbearance to avoid making any payments while you wait. That's what a lot of my clients are doing right now. But yes, you can absolutely get credit for this time. You just have to buy back the months. So once you're approved, they'll give you a lump sum payment amount that you then have to pay within 90 days.
Perfect. Now, in conjunction with this, somebody is asking, how can they tell if they have PSLF qualifying payments?
Yes, great question. So the easiest way, so studentaid.gov, the beautiful thing that recently came out of like the past few years here is there's now a really helpful PSLF payment tracker. So if you log into studentaid.gov, if you have submitted at least one employer form through the help tool, you should see some green bars showing your PSLF qualifying payments. If you don't see anything, but you've been working at an employer, that means you have not yet documented any of your employment history. So what you need to do, the most important thing in the first step is to go to studentaid.gov, search for PSLF help tool, and use that help tool to document your employment history. So you'll put in the employer EIN number, which you can find in box B of your W-2, or you can go on GuideStar, or maybe it's Candid now. I have it linked on these slides to find the EIN. You'll put your start and your end dates, and then an email address for someone at the employer who can sign off on it. So once you submit it, it goes to the employer, they sign off on it, and then federal student aid processes it. And then your payment count will increase then on studentaid.gov. And it will show the months that are qualifying and the months that could qualify if you submit employment information. It's really helpful.
Perfect. All right. I'm going to keep going if you're good.
Yes, I'm great. These are great questions, everybody. Thank you so much. I appreciate it.
All right. So this attendee says that they are researching this for their children. If someone doesn't recall their repayment plan, can they find that by logging on to studentaid.gov?
Yes, you should be able to. That's what's kind of interesting is that if you go to your loan servicer's account, like Nelnet, Mohila, Advantage, and see a monthly statement, it might not always have the repayment plan listed, but it will have the due date and the amount. But if you go into studentaid.gov, You might see it on your homepage. Otherwise, you might have to dig into the loans a little bit. And of course, they recently changed I'm trying to like picture it in my head because I'm a visual person, but if you drill down into the loans, you will be able to see which repayment plan that you are on. It might just take a few clicks to kind of get there, but you basically are trying to get into the loan details and it will list the repayment plan that you're on for your loans.
Perfect. All right. Another good question. Do all loans have to be consolidated before applying for any IDR plans?
Not all loans. That's a good question. So, Parent Plus loans, if they have not been consolidated, then yes, as long as that loan disperses before July 1st, that does need to be consolidated if it doesn't already, because Parent Plus loans on their own do not, or they're not eligible for income driven repayment plans, right? If you have direct loans, they don't necessarily, direct consolidated or sorry, direct unsubsidized, direct subsidized, those direct grad plus, those don't necessarily need to be consolidated by that July 1st deadline. I'm trying to think, if you have older loans like FEL loans, that can be a little bit more complicated because FEL loans don't qualify for PSLF. So you might want to consider doing that if you need to. But no, it's certainly not the case that all loans need to be consolidated by that deadline.
Okay, perfect. All right, another one. I was put into deferral, made payments to reduce balance, tried to apply for the new IDR and was declined because I was paid ahead and told I needed to opt out of paid ahead to find out if I would be approved or how much the payments would be. So the question is, should I opt out of the paid ahead status?
That's really interesting because I know what you're talking about in terms of being in paid ahead status. I have not run into this issue before with my clients or with any of the students I worked with, or even for myself too, when I was in paid ahead status for a little bit during COVID. If you, well, I should say it this way, if you need to apply for pay before the July 1st deadline, then I would maybe consider getting out of that paid ahead status. I have not It's difficult for me to give you concrete guidance because I have not run into this issue before with being in paid ahead status impacting someone's ability to switch repayment plans. So yes, if the goal is to switch plans and you need to get out of that paid ahead status to switch plans, then it sounds like you're kind of, they're kind of forcing your hand there, especially if you want to get on pay before that July, the potential July 1st, 2026 deadline. So that was kind of like an answer, non-answer.
So someone else is wanting to clarify. So they weren't talking necessarily about deadlines, but do they need to be consolidated before applying for IDR? So I guess they're asking overall, do all of your loans have to be consolidated before you're eligible for any IDR plan?
Not necessarily. No, that's a good question. So you do not necessarily need to consolidate, regardless of the loan. It of course depends on the loan type. I should say, but you do not necessarily need to consolidate all of your loans in order for them to be eligible for income-driven repayment plans. And if you're kind of curious too, you could literally go to studentaid.gov and go to the income-driven repayment plan application. Just kind of go through it, especially if you do consent to IRS access, which sometimes people do or do not want to do. Kind of is up to personal preference and the goal. But you should be able to go through and get to the very end where they show the plans that you're eligible for. And just in case you're curious to see which ones, what you're eligible for and what the monthly payments would be, it will show you an estimate there. So you don't need to submit it. You can literally just go through it just for, curiosity or education's sake too.
Perfect. All right. We've got two more out there.
Perfect.
First, if the borrower would like to pay the unsubsidized loan before finishing school, will they be charged interest lesser than if they wait till graduation?
Yes, that's a good question. So on unsubsidized loans, simple daily interest does accrue. So the sooner you pay off those loans, the less interest you will pay over time. Yes.
Okay, perfect.
Good question.
All right. We have one more. Are settlement offers or bankruptcy still possible?
Yes, that is a great question. So I'm not a bankruptcy attorney, and so I can't speak to someone's specific circumstances or cases, but that is a big Yeah, what do I want to say? Like a kind of a myth that exists is that it's impossible to discharge student loans in bankruptcy, and that is certainly not true. Of course, please meet with a qualified student loan attorney who's familiar with working with clients who have federal student loan debt, because of course it varies state by state too. But it is indeed possible to discharge federal student loans in bankruptcy. I'm less familiar with private loans just because I mostly work on federal student loans, but it is possible to do that. And there's also, if someone is disabled, you can get them discharged through total and permanent disability discharge as well. So I've worked with clients on that before too, who maybe have come down with a really severe health circumstance too, that it will likely not get better soon. So please know that total and permanent disability discharge, or even closed school discharge, things like that, there's other opportunities that may exist too for folks out there.
Perfect. Well, this has been some great information. We have a couple more comments, not really questions, but there are several people that are saying, thank you, Emma, for all of this information. And then there are some that are asking about how to get in touch with you. And so I just wanted to say that you can find her on our website, like she said, octoberloans.com. And we will be sending out these slides and the recording to everyone who has registered. So you will find all of her information there as well. And so I want to thank you, Emma, for being here today and sharing your expertise with us. And, you really broke this down. It's such a complicated and fast changing topic. And you really, made it practical and approachable for all of us. And so thank you so much for that. And I also want to thank all of you that joined us today for the webinar and submitted such thoughtful questions. We know that student loan repayment is overwhelming at times, especially with all the recent changes. But, our hope is that today's conversation gave you some greater clarity and a list of helpful resources and a few actionable next steps that, you can take moving forward. I said earlier, and I'll say it again, at America Saves, we truly believe that financial wellness starts with access to trusted information and support. And conversations like these are just such an important part of helping you, our savers, and families feel more confident in their financial journeys. And so, as for us from America Saves, we'll also be continuing this summer education series with additional webinars and financial wellness topics throughout the coming months. So we encourage you to stay connected with us through our emails and our social channels for upcoming events and resources. If you're not on our email, all you have to do is go to americasaves.org and take the pledge. And then we'll be in your inbox with what I call tips, tools, and resources to keep you motivated and on track. Also want to encourage all of you to tune into our podcast, Think Like a Saver, as well, where we continue these conversations with experts like Emma and our partners on topics that support your financial wellness and saving success. So again, Emma, I cannot thank you enough for being here today. And thank you to everyone else for spending part of your afternoon with us. We hope you have a great day, and we'll see you back here soon.